Welcome back, Luke Gromen. How are you, buddy?
I am. Thank you for having me. I apologize. There was a little bit of a goat rodeo between my calendar and myself earlier this week, so I apologize for that.
You're in too much demand, Luke. I mean, the RSI on you is like over 90.
Oh yeah, you should short the shit out of me here.
Yeah, no, the bullish you're on national television. Let me ask you this: how many interviews do you do a week? Would you guess?
I actually don't do that many, and because I try to really limit it to one, to be honest, at most. And I also make it a point to state of my commitments, and I committed to you I would be here, and B, you were an early supporter. You had me on back when 2017, or when I was getting going, and so I appreciate absolutely that. So this week's been busier. There was a couple I recorded months ago that are getting released this week and stuff, but it's usually not too bad.
Well, I sometimes the market provides the questions for me to ask of you, and let me get rid of my mug. You're off camera today, right?
I'm trying to start the video, won't let me, but I can be on video. Yeah,
all right. Anyway, the narrative that I have been reading from you is, there's like this circle that because we've had a huge move up in oil, that China and other countries will sell treasuries to get the dollars to buy the oil. And this has all been feeding upon itself, the dollar going up, oil going up, treasuries going down. So my question for you is, this has been a pretty vicious decline in oil. Does the narrative change with this price break of almost $15 a barrel in a week?
In the short run, yes, absolutely. What that looks like to me is an intervention. I think the Treasury Exchange Stabilization Fund stepped in and bombed oil, because where the Treasury Move Index went out on Monday with that huge drop in treasuries on Monday, or I guess it was Tuesday. It went out at 141. So we were into very dangerous territory. We were getting close to a treasury market crash, full stop. And I use that word specifically. The treasury market was very close to a crash. You would have seen yields do what repo did in September 2019. You would have seen the 10-year yield do what gilt markets did a year ago. And so I think what we just, you're
not the first person I've heard saying that the selling was going to come from the Fed desk.
It could be the Fed, it could be Treasury. I mean, but in my opinion, it's an intervention. I think it is. I have no way to prove that, but it looks like an intervention.
All right.
Sorry, Dale. Luke, sorry to interrupt. I just want to say you should have the ability to show yourself on camera now, Luke. So apologize for that.
That's okay.
Yeah, there you go. Perfect.
I'm like Barney Fife. They only give me one bullet. So, you remember that? Anyway, okay. So intervention, and it's interesting you say that, because you're not the first one I've heard say that. I think the guy's name is Albert. I am live at something, and he was talking about that on a show I was with him on last week, and everyone knows that they're active. I mean, people know the plunge protection team, and but people don't think that they'd come in and do an intervention in the energy markets to try and keep the whole balancing act together. So then this would probably be a break to buy in crude, because interventions normally don't work. The market is bigger than whoever's intervening. Isn't that usually the case?
Yeah, and I think it's here too. I mean, ultimately, like so much of Western policy in recent years and decades, like the releasing of the SPR last year, this will prove to be penny wise, pound foolish on an even shorter time scale. Because last week, U.S. shale basin participants were saying, look, we're not going to expand production because OPEC could come in and drop oil from 80 to 60 in a week. And then we're dead. So
our oil industry has post-traumatic syndrome. They don't they?
Yeah. Well, they do. Yeah, they do. And so the way to think about this as a trader is, once again, the U.S. government, as in March of last year, March of 2022, once again, the U.S. government had a choice: the oil market or the bond market. And in 2022, they chose to save the bond market over the oil market. And that has got cost ultimately, right? You put in oil price controls with the SPR release and aggressive rate hikes, and then you get what we had in the last 3 months in oil. You get shale production rolling over, as we're seeing. That's what you get. So you do this. This is desperation. This is what this is. And so, yeah, you absolutely buy this break in oil. We wrote to our clients on Friday, hey, we just had a spidey sense that oil could get whacked here. We wrote that in our report. It was the first time I've written negatively about oil in like forever. And said we'd sold some of our oil positions, et cetera. And said that if we were managing a monthly book, we would actually move to buying puts on oil. Better lucky than good, I guess. But I would be taking those off and buying oil here, because all they are doing is reinforcing the future supply shortage of oil and making it much worse, because they are reinforcing in U.S. shale's mind, you can't grow production. It's not safe to grow production. And so production won't grow. And in fact, the geology of shale ensures they will continue to suffer from that steep decline rate. So just a really, it is what it is. It's good for TLT for a cup of coffee, but again, it doesn't, it's penny wise, pound foolish.
All right. So TLT, I think the only thing that could save TLT is just like the Fed will sacrifice every other market to save the bond market, they need to crush the stock market to have some type of money flow, even though people have PTSD on bonds too, that they never work even during a liquidity crisis or a big bear market. Maybe this time they would. Can they crush this equity market? Are they on the way to being successful in doing it? Or is this just, like a lot of the bulls say, a pause to refresh, normal pullback in a ongoing bull market?
They can try to do it. I've heard a number of bond bulls say that's what they're going to do to save the bond market. The problem is that it won't work. If they crush stocks to save bonds, they'll crush bonds too. Okay. And I've been highlighting for years that the key marginal driver of U.S. consumption and tax receipts is the stock market. And for a while, people for a while said it was crazy. And last year was sort of the piece de resistance of proof that I was right, which is unemployment was 3.5%.
Right.
Withheld tax receipts never fell, and tax receipts fell 20%. Why did they fall 20%? Because non-withheld tax receipts fell sharply. What are non-withheld tax receipts? Capital gains and stock comp, executive-based stock comp. So if they so last year, the downdrift in the market, which didn't even last the full year, by the way.
Right, into October. Right.
Yeah, it knocked $500 to $600 billion off of tax receipts, which means it increased Treasury issuance by $500 to $600 billion. It increased the deficit and Treasury issuance by that much into an already existing Treasury supply demand mismatch. And people say, well, that means they just have to do more. They have to hurt the stock market more. If they hurt the stock market more, they will put the economy into a recession. You put the economy into a recession. The last 3 recessions have seen U.S. deficits rise by 6%, 8%, and 12% of GDP. 6% of GDP is $1.6 trillion more in issuance. 12% is $3 trillion more in issuance. So that would take our deficit from the 2.2 it is today to 3.8 to 5. Now, in a recession, the banks are going to have enormous credit losses. They're already moving in that direction with credit, with consumer, or excuse me, commercial real estate. Credit cards will probably come, auto loans, it'll all come. Well, the banks were regulated into buying 4.6 trillion in treasuries and mortgage backs.
At the highs when TLT was 170, right?
Yeah. Oh, and this has been a 10-year process. It started in 2014 when the Chinese said we're done buying treasuries. Banks were regulated into it, money market funds were regulated into it, pensions were regulated into it. And then in 2020, to your point, the banks at the absolute highs, they yanked, the Fed took off SLR exemptions and said, buy treasuries yielding 1 at the 10-year with infinite leverage. You don't have to have capital requirements. And they encouraged the banks to put on an infinite leverage buy of trillions of treasuries with the 10-year at 1. And so if you have a recession, you're going to have the deficit blow out by 1.6 to $3 trillion, more supply. You're going to have 500 to 600 billion at least if we just equate from the modest selling last year to the tax receipt implication. You're going to have the dollar go up in a U.S. recession. And if the dollar goes up, foreigners have 7.5 trillion in treasuries to sell, and they will sell them until their hands bleed because they're going to need dollars. The banks are going to be taking credit losses. They will sell treasuries until their hands bleed. They have 4.6 trillion at the peak. They've only sold 500 billion. They were creating enough dysfunction in the treasury market in March that the Fed had to step in with BTFP, which is just a swap line for the banks so they don't have to take the capital losses selling treasuries. So the point here is that I've seen multiple very respected people say they just have to crash the stock market to drive a bid for bonds. I can't tell you what a galactically bad idea that would be. But if they crash stocks to drive a bid into the bonds, what they will do is crash the bond market too, because the supply of treasuries, we haven't seen supply yet. There will be 6 trillion, 7 trillion offered, and nobody has the balance sheet. Nobody. I mean, global GDP is 90 trillion. If it was growing 5%, that would be 4.5 trillion. The U.S. deficit the net effective treasury supply would be over 100% of growth, which means, okay, they'd have to sell other things, but it goes into a death spiral. If they crash the stock market, the system goes into a death spiral, including bonds. There will be no bid for bonds.
Okay. I'm looking at the regional banks here, Luke, and with TLT making new lows, taking out the October lows, if they had problems in March, their problems are even bigger now with their books for their long duration trade that you said the Fed regulated them into, or okay. So the Fed told them to do this. The Fed knew then when they went on their tightening regime that this was going to damage the banks big time because they didn't put out any note and say, hedge, get out.
Well, my understanding is
why did they do that? I mean, it almost seems like it was by design. You get someone to take the bait and then you pull the rug. I have this, kind of out of outer space view that the Fed by design is creating a confidence crisis in the banking system. So a year or so from now, the CBDC could be a fix that the public will be so worried about their holdings in banks. And perhaps maybe by then, this dollar rally is over. And, we start to have a bear market in the dollar, and it's good. This would give them the ammo to replace the physical cash, get rid of cash and go CBDC, because they'll say it'll fix everything.
It's entirely possible. And if that's the case, that's sort of the end of the country, to be honest. We're no longer a democracy. We're a centrally planned communist country.
Do you think it's going to happen, Luke? I mean, I
hope not. I hope not. But it's very possible. But it's, these, the banks, they were regulated into it. My understanding is that if they hedged, they were not allowed to classify the bonds as held to maturity. And so they would have had to written the losses into earnings if they hedged.
Okay.
So,
Look at all these banks.
oh, and this is why I say like crashing the stock market is to drive a bid for bonds. It isn't going to work because Larry McDonald had a tweet out a couple days ago. He said at 4 to 5% rates, Bank of America is 45x levered. At 6 to 7% rates, they're infinitely levered. They're insolvent. It's over. And that's before we get into like credit losses. So like, I think what we're watching in bank stocks is just the market saying, if you sell these bonds, you're going to have to take these losses, and these losses will wipe out a substantial portion of your capital base. And therefore, we are just going to sell your stock down to a level that reflects that wipeout of that capital base. And like I said, if they don't get the dollar down and they don't get oil down big, and like I said, okay, they bought time with oil, they bought time, but nothing else has changed. They are
Okay.
The Fed has triggered off a doom loop that will take down. I mean, it's a systemic risk.
Okay. So that, I mean, to me, it sounds like you're looking at the dollar with this recent rally, and gosh, look at this persistent rally, Luke. This is a record in the dollar. I think 13 weeks up.
Yep.
All blue candles.
Yep.
So are you in the camp, kind of like the Brent Johnson camp, the milkshake theory, that the dollar's this was not an important high that we put in at 114 in 2022, and that we're going to blow past it?
I concede that is entirely possible. I don't think it's going to happen for a simple reason, and that is that the United States Treasury market will crash like October 1987, like September 2019 in repo, like the gilt market. And I'm going to be careful because
Will the crash cause a flight out of the dollar finally when people really throw up their hands?
It'll cause
the dollar.
Gold. What will turn the dollar? What will turn the dollar? The Fed coming in and saying we cannot afford 7% rates. That's the thing that I think the big thing I hear, the dollar milkshake, and Brent talks about the Soros imperial cycle of the dollar, the Stan Drucken or the Druckenmiller Soros strong dollar playbook, right? Where you run big deficits and you squeeze the dollar higher. They always leave an important part out relative to that Soros imperial cycle of the dollar, which is when we ran that playbook, the United States ran that playbook in 1980, US debt to GDP was 25%, 30%. Deficits were 2%. When the Germans ran that playbook for the Deutschmark, as Soros famously is Druckenmiller is famously quoted on, when the Germans ran that with reunification in 1990, German GDP or debt to GDP was 20%. After reunification, it was 40. The United States is 120, plus cash flow negative entitlements coming on balance sheet, plus deficits of 8% plus. So you don't get to run the imperial circle on the dollar unless you're willing to crash your treasury market.
Okay.
And if you crash your treasury market, that's the collateral backing your banking system. Banks are gone. Treasury market's gone. And at some point in this process, people are going to go, oh my God, the risk-free asset has risk. My money in banks has risk. Where do I go? And
CBDC.
That's what they'll do.
Yeah.
that's what they'll do. And the reality too, I think, is you'll see the gold markets start to rise with rising rates. I mean, it's already been puzzling to a number of people why gold has not crashed with the spike in rising rates or rising real rates. It's completely diverged from real rates. I think that will
until recently, it's finally caving. Who's behind this? Is this the Fed too?
I would bet it probably is. Yeah, I bet it
okay, because I started buying physical yesterday, and I haven't done any leverage trades yet. But I think that this could be a generational low here.
I agree.
1780 in the next few months. That it's the only way I could think about getting through this is with gold and silver and maybe speccing in mining shares. What do you think?
Yeah, and it's the way out for the government too, actually. The Fed's operating manual says at any point, Treasury can instruct the Fed to revalue the gold. And so if I was running things, let the Treasury market really get desperate, right? The only way Wall Street is going to accept $10,000 gold, $20,000 gold is if they're on their knees begging. So let the Treasury market crash to 8 or 9%, 10%. They're all begging. The banks are all begging. Everybody's begging, save us. And my solution is ring, ring. Hey, it's Luke at Treasury. Powell, every $4,000 in the price of gold is $1 trillion that gets deposited mechanically into the Treasury general account. I want you to write the gold up $25,000. Let's do 24,000 for easy math because it's one for every 4,000. I want you to write gold up $24,000 per ounce in the U.S. official account. That's the new price of gold. And that will deposit $6 trillion into my TGA. The $24 trillion Treasury market with rates at 8 or 9 or 10% has been written down to 12. And I step in with $6 trillion and I buy it back for 50 cents on the dollar. The U.S. debt to GDP is now 50. Fed can lower rates. Fed can do whatever. Fed can be independent again. Have a good day. Thank you for your donation to recapitalizing the United States bondholders. If you own physical gold, feel free to take it to your local JP Morgan branch and deposit it where they will credit your account for $24,000 per ounce. And I think that's how this is going to go.
Wow. What do you think silver would be? $20? Because they're revaluing gold, and the gold silver ratio goes back to 200 or something like that. All right.
I think silver goes up, but yeah, but not nearly as much as gold.
Okay. All right. And any vibes on BOJ and when they're going to give up yield curve control? Because I mean, there was this weird spike the other day in the end, and everyone thought maybe this was intervention, but no one could confirm it, and the BOJ guys aren't talking. What do you think's going on here?
I think they are increasingly desperate, and they are if what's happening in the Treasury market is a fire, they are gasoline on that fire. Look, what we're watching is the first global sovereign debt bubble in 100 years burst. Okay. And that's what we're watching. And what Japan's role in this is they're on the opposite side of the U.S. net international investment position. They've got a positive net international investment position of 60% of GDP, right? So they own $3 or $4 trillion net in U.S. dollar assets. And they will, when they need to, they can sell dollar assets until their hands bleed and throw it onto the lap of the Fed, throw it onto the lap of Treasury. Sell me more treasuries to defend my currency. Sell me more treasuries, sell me more. It's not our problem. And they can do this for a long, long time, a lot longer than the Treasury market can afford this. If the US government had 25, 30% debt to GDP, who cares? Now at 120, Japanese go, sell some more, sell some more, sell some more. And all of a sudden, US government's going, we can't afford the Marine Corps. Now we can't afford the Marine Corps and the Navy. Now we can't afford the entire DOD because our interest expenses. So now we can't afford it. The whole budget is interest. And that'll probably happen before Japan runs out of treasuries to sell.
Okay, I think we just uncovered what could be the catalyst for a bear market in the dollar.
Yeah, they've got to weaken if the dollar doesn't go down, like oil buys some time. It does. What they did with oil buys some time. Whoever did it, whatever, if it's organic, I doubt it, but whatever. The decline in oil buys a little time. The dollar needs to go down 10%, 20%. And if it doesn't, like you buy oil and you go back to sell, you buy this oil tank and you sell this treasury bounce that we had yesterday. Because there's nothing, and you buy the dollar weakness yesterday. There's nothing stopping this, and gold will do crappy, probably down to your level. And then gold will start rising even as rates rise. And people go, why is that happening? And the people in Argentina will go, I know why it is. And the people in Turkey will go, I know why gold's going up with rates. And the people in Brazil will go, I know why. Like every emerging market in the world that I talk to is watching what's happening here. And they're like, guys, like, hello, McFly, you know, just because you're Westerners doesn't mean you get a pass, you know, on debt. 98% as of 2021, 98% of countries going back 120 years that had debt to GDP where US debt to GDP was in summer of 2020 and deficits where they were in summer 2020 and 2021 defaulted on their debt. Mostly in inflation terms. They mostly inflated debt to GDP down, sustained period of very high inflation. A few did restructure the debt. Now that was as of 2021. In the meantime, the one country out of all of them, out of 54, to get to that 98% that hadn't defaulted was Japan. What are we seeing happen to Japan? Things ain't going so good in Japan now, are they? So we're really looking at a 100% chance going back 120 years, which, as you know, Dale, 98% shots in this business don't come around much, let alone 100% shots. And so people always say it's never different this time. The key is the path and managing your chips. But like this global sovereign debt bubble is centered in the West and it is accelerating and there's nothing's going to stop it unless the dollar is devalued meaningfully. Oil down buys it time, but failing that, you got to get the dollar down big. And that's going to have to come from some sort of big agreement, intervention, etc.
Like you know, like a Plaza Accord in reverse.
Exactly. And that ain't going to happen because we're busy trying to kill China and Russia's invaded Ukraine, and you know, we just cut off, you know, Europe. European leaders, oh my God, like I don't know what they're thinking.
Yeah, I mean, so many pots on the oven bubbling over.
Yeah, you're just not going to get any cooperation.
Yeah, and I've never seen you more amped and with higher level of conviction. Tells me that you know, we're in the later innings of things you've been talking about here on From the Forest, From the Trees, right here, the forest for the trees. Luke Gromen's website. You could follow Luke on Twitter at Luke Gromen. Check it out. And I've seen so many great testimonials of people that during these times, I felt pretty agitated with everything going on, the test, and you know, now the U.S. can't. I forgot the name of the company. They won't move our ships. They're butting up with China, so now we have logistic. Yeah, now we have logistic issues. That's really a bad supply chain issue to have, not to be able to move your military. So you know, I've read how you bring a sense of peace and calmness to people once they could see through all the noise and that they're able to go on living their lives and feel like they're on course. So
thank you.
Great mission you're on, Luke, and you've been talking about this for a long time, where it seemed like it was some time off in the distance. Seems like the curtains have lifted on this and the play has begun.
Oh, absolutely.
All right, Luke Gromen, everybody, thank you so much, my trading warrior brother. Great having you. I learn every time you and I have a conversation.
Likewise. I appreciate you having me back on, Dale. Always enjoy it.
Luke Gromen and everybody, follow him. Should be important to your intelligence gathering. Check out his writings. It will help you navigate or not have to worry about navigating what's coming. So that's a wrap. Thank you, everybody. Hope you enjoyed. And you could join the team in 14 minutes on the Morning Edge. And we'll see everyone for the NFP Trade It Live with us tomorrow. And looking forward to reacting to the reaction. See everyone tomorrow. Adios. I'm glad you liked it, Sherry. I'm glad you enjoyed that interview. Luke's awesome. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.